when you do a Roth conversion, you guys have to understand that all these retirement companies are in cahoots with the IRS. Remember, when we pull money out of Roth, it comes out at 0%. And so what's cool about Roth and what's cool about passive income through real estate is, let's say you got $1 million Roth IRA, or you got $1 million Roth 401k, and you're drawing 80 to 100K a year on that thing, it doesn't jump your tax bracket. The way that this works is, let's say I've been contributing to my 401k and I have $100,000 in my 401k. Okay, now that's all traditional, which means I got a tax deduction on that money equal to the 100K that I put in, multiplied by whatever my tax rate is. Let's say over that time my tax rate's 30%, right? So I got a $30,000 tax deduction by putting the money in. I save $30K in taxes. But when this 100K grows to 500K eventually, I owe taxes on that money when I go to pull it out. Now, the trick is to make sure that your tax rate when you pull out is lower. But assuming, let's just say it's the same across the board, like I save $30K in taxes just to owe $150 down the line. And so anytime that an opportunity presents itself to either lock in a lower tax rate or convert when the stock market's down, you want to think about doing that. Okay, so for example, let's say the 100K that I had invested, it turns into 80,000 because the stock market took a huge dip. Well, when I go to convert that, I'm not paying taxes on 100. I'm only paying taxes on 80 because that's what the account's actually worth. So I save $30,000 in taxes because I contributed 100K. But when I go to convert this, I'm only paying 80,000 times 30%. I'm only paying 24K to convert that over to Roth. So there's really two times when you do a Roth conversion. The first time is when the stock market's down a lot, which I believe the stock market's still up over since the beginning of the year. It just went down like 3% in one day though. Anytime the stock market goes down, and then anytime your tax rate goes down. So the reason why your tax rate could go down is maybe you quit your W-2 job and you're not working for the full year. Maybe you got married. Maybe you bought real estate and were able to use that real estate to offset some of your income. But any time that the number one, the stock market goes down, and number two, your tax rate, I call it sometimes a shock in income, like your personal tax rate fluctuates, that's when you want to be looking into doing a Roth conversion. Because back to this example, let's say same example of the 100K, except maybe the stock market didn't go down, but my tax rate did. Let's say my tax rate goes from 30% to 20%. And again, I saved $30,000 by contributing to that 401k, but my tax rate's only 20% now. So I'm going to go and do a Roth conversion. I'm going to pay $20,000 in taxes. But you see how I took advantage of this like $10,000 spread right here? Now all my money is in Roth, so it's going to earn and grow tax-free for the rest of my life. Okay? And if that's confusing to you guys, definitely go and watch. I just posted it in the school group. I did a breakdown of traditional versus Roth accounts because I think wealth building, a lot of people, especially in real estate, they're like all in on real estate, when I think a lot of people should be having diversified streams of retirement income. So, but when you do a Roth conversion, you guys have to understand that all these retirement companies are in cahoots with the IRS to basically force you into doing withholding, okay, for lack of a better term. And because let me explain this. So let's say I want to convert $100,000 from traditional to Roth, okay? By default, so if I go to Vanguard or Charles Schwab or TD Ameritrade or Merrill Lynch or whoever, by default, they're going to want me to withhold. And it's typically 22% is like the federal withholding mandate. They're going to want me to withhold 22% of that money, okay? So what that means is I want to convert $100,000 from traditional to Roth, but they're going to hold back $22,000 to pay the taxes on that conversion, okay? So what's going to happen is $100,000 is not getting converted over to Roth anymore. It's only going to be the $78,000 that's left over, because they're taking that conversion money, they're withholding taxes on that conversion money, and then they're putting that into the Roth account. So anytime you have the option, you want to make sure that you check the box, or you call the company before you convert, and you want to tell them that you don't want to withhold taxes on the conversion. Instead, you're going to pay those taxes with out-of-pocket money, or you're going to pay those taxes at the end of the year when you go to file your tax return. But you don't want to withhold money, because now less money is going into Roth. Instead of $100K going into a Roth account or like a Roth IRA, only $78K is going to go in the Roth IRA. So when you guys convert from traditional or Roth, make sure you don't select the button or the option that says to withhold on your conversion. Are there income limits to be able to convert? No. That's what's really beautiful about the Roth conversion, is that you can make $1 million, $10 million, $100 million a year. It doesn't matter. Anybody can convert over to Roth if they want to. Now, there's obviously restrictions, and as far as like, you don't want to, if your tax bracket's super high, like if you're 37% federal and then let's say you live in California, so you're 13% state, like when your tax bracket's 50%, you probably don't want to convert over to Roth because now you're paying 50% to do the conversion. But there's no monetary income limit when it comes to converting a Roth account. So, and let's see, the backdoor Roth account, I can talk about that for a while. I wanted to make sure that I get into this other topic, but just a backdoor Roth for you guys to understand is that most people, I think if you're single and you make more than, what is it now, 130, 140, or if you're married and you make over like 200K, you can't contribute directly to a Roth. So you can't just go and open up a Roth IRA and put your money right into it, okay? You can't do that. It's a stupid thing, but what you have to do is you have to contribute to a non-deductible traditional IRA. So you go to Charles. I like Vanguard because that's what I do. I don't get any money from them, but I should. But you go to a Vanguard, you set up a non-deductible traditional IRA. You're typically going to wait 4 to 5 business days for that to kind of sit there, and then you convert over to Roth. Convert to Roth. Okay, it's a really stupid rule, but that's just the way it is. If you make a high income, you can't contribute directly to a Roth IRA, right? But you can go to a non-deductible, wait 4 to 5 days, and then convert over to Roth. And then, yes, that's where you get into the pro rata rule. Basically, if you have non-deductible and you have Roth money, you run into this thing called a pro rata rule. That's more for like a financial advisor. But these are just different types of options that you guys have with your retirement. And this all goes back to what I talk about, the financial freedom matrix, right? So I've showed a few of you this before, but every income stream that you're going to have towards retirement age, it's going to get put into one of these 4 buckets, okay? So there's the earned bucket that we've talked about before, which on a federal level, the max is 37% that you're paying there. And then you also have Social Security and Medicare taxes there, right? So if you're a high earner, like this can easily be 42, 45% in taxes that you're paying on that income in your working career. We got the passive income bucket, right? So that's going to be anything real estate, long-term rentals, short-term rentals, multifamily homes, RV parks, anything's going to be passive. I mean, most of our clients pay 0% on their rental income because of all the different types of deductions and expenses and strategies that, as a real estate investor, you can use to help pay little to nothing in taxes. In fact, like for a lot of you here, we actually are teaching you guys or helping you guys use the losses from your rentals to offset your active income, right? Now, the other bucket that we talked a little bit about today is that retirement bucket. Roth or traditional. So remember, when we pull money out of Roth, it comes out at 0% tax bracket. But more importantly, what it also does is it doesn't jump your tax bracket. So for example, like a lot of people who draw Social Security or they have pension or other retirement benefits, it kind of screws with their other income because it's setting this floor of money that they're already receiving. So that way when they receive more money, they're getting taxed at a higher rate on that. It's kind of like, I use the example of how water and oil mix together. And so what's cool about Roth and what's cool about passive income through real estate is you could have a $100K a year income stream. You know, let's say you got $1 million Roth IRA or you got $1 million Roth 401K and you're drawing 80 to 100K a year on that thing. It doesn't jump your tax bracket. So then when you go and pull Social Security and you go and pull traditional IRA, like it's not going to raise your tax bracket, which is really cool. So 0% on Roth, 0% on passive income. And then the last bucket that we haven't talked about yet is that portfolio bucket. So that portfolio income, that's going to be, this is non-retirement, okay? Non-retirement, but this is going to be like a stocks, your bonds, your interest. That's going to be the portfolio bucket of things. And this is also really cool too because under current law, if you're married and you don't have any other income, you can withdraw up to $120,000 of capital gains completely tax-free, $0 in taxes, okay? And when I say other income, I just mean other taxable income. Because for example, if I drew $100,000 from Roth and I had $100,000 of rental income and then I drew $120,000 of long-term capital gains, I just had over $300,000 a year of income in retirement and I'm paying $0 in taxes. Why? Because Roth is $0 in tax. I'm not paying any taxes on my real estate. And again, if you don't have any other income, capital gains, you can withdraw, if you're married, you can withdraw up to $120,000 a year of capital gain money. And that's going to be completely tax-free. So you could have over a $300,000 a year income stream as long as the money that you're pulling out is in these three buckets, okay? So the name of the game is, how do you take your money that's sitting over here and earned, right? So our earned income through our day jobs or our businesses, how do we funnel that into one of these three different categories right here? Whether it's real estate, passive income through real estate, it could be passive income through owning other businesses. How do we funnel that into portfolio income? We got stocks, we got bonds, help with cash flow, help with liquidity. Again, remember, those are outside of our retirement accounts, right? And then how do we get that money in Roth, right? Because for most of us, we're going to be working positions where our tax rates are going to be pretty high, okay? Now, anytime that you can take advantage of that, where you find your tax rates super low, like I said, you get married, you buy some rental properties, so now you're using those losses to offset it. Like anytime you can get money in Roth, like let's do it because it's going to come out tax-free when you eventually go to withdraw it. So any questions on this? I hope this all makes sense.
Hey, good morning, Ryan. It's Glenn Delendo.
Hey, how's it going?
Hey, I'm doing well. Question on that Roth. I'm just curious. I'll just throw out the numbers. If I have a big chunk of 300,000, but my effective tax rate did go down because of my real estate from last year, do you recommend chunking? I think like that other member mentioned, or do you recommend like just throwing it all into a Roth to convert it?
Yeah, so I would like by default, I would say never just do it all at the same time. But what you said right there is chunking. I like that. I think I've heard of that before. What I like to do is see where I'm going to be at taxable income wise. So like last year would have been a good year for you to do it, but the past is the past, right? We can't go back and change what happened in the past. But This is what I would do. So what you're going to want to do this year is figure out for 2024 what your taxable income is going to be. Okay. The reason being is you really, the two big cliffs here, and I think I know where you're at, but the two big cliffs here are going to be this 12 to 22% and then this 24 to 32%. Okay. So let's say for example, I'll just use a number. Like let's say your income's $300,000. I'm just making up a number. So that puts you right here at the 24% bracket. Up until once you make 383,000, now you're in 32% bracket. Okay? So if I was making 300K, I would only convert $83,000 in Roth. Okay? Because that's going to be at 24%. And then as soon as I hit that 383, now I'm in 32% bracket. So I wouldn't want to convert any more than that. Does that make sense?
Yeah, no, I got it. So it'd be advisable to kind of, like you're saying, go over like towards the end of the year, so you get an idea where your, proposed, I guess, effective tax rate will be, because that's how you're going to play the game of how much to chunk in for this year, and then I guess subsequent years after that, to where I got like that whole 300,000 shifted over.
Yeah, exactly. Because like let's just say, for example, like your income this year is 100K. I don't remember what it is off the top of my head, but if you're at 100K, right, you're in the 22% bracket. So if you just chunk that whole 300K, you're gonna pay 22% on 100K. You're gonna pay 24% on another 180, and then you're gonna pay 32% on another 20. Instead, you probably just want to convert up to whatever that tax bracket's going to be. Now, like I said, the 22 to 24% jump isn't like that big in the grand scheme of things, but for a $300,000 account, that's a 6% spread right there, which means that's a $6,000 difference right there on a $300,000 account. So it is pretty important, by the way, I think, because so if your income was let's say we sat down in November and you're like, okay, my taxable income is going to be $100,000. Well, I would ask like, hey, is there any chance that it's less than $100,000 in the future years, because maybe we're able to convert some of that money at 12% in the future. And we don't want to convert it now because we could have converted it at a later time in the future. But if you're like, no, I'm making 100K, I think it's going to be 100K for a while. Well, then we just go and take up to this number, basically. And think about that too. Like you could convert 100K on December 15th and then go and convert another 100K on January 2nd. And those are two different tax years. Especially if you're like, hey, the stock market's down right now. I want to convert it right now because I'm paying less in taxes, because the 100K that I had is now only 90. So when I go to convert it, I'm paying taxes on 90 instead of 100.
Right, and that's what I caught my interest when you were mentioning it earlier, that because the interest or the market went down whatever 10% or few percent, but then it's like, is that the time you jump in to do a little bit of a chunking? And I've heard it before, because like you're saying, like you just gave the example, do 100 in like December, and then as soon as January comes around, you do another 100. It's practically two different tax years, technically.
Yeah. So the thing with the Roth conversion is it really just has to be done before, if I had to give you a deadline, I would say like December 15th at the latest, just because it could take a couple of days for the paperwork to process. And if you don't want anything to hold it up, like they might not have your address or they might not have your phone number or information like that. So really maybe call it like December 5th. Like you want to get your conversion done by December 5th, and by that time like you're going to have 11 months of your income, so you should be pretty clear on like what your tax bracket is that year. So then you could go and make that conversion early December, and then assuming that the next year is going to be very similar, just go and convert the same amount in January if you wanted to.
Right. I think, that's why I was kind of going off what you guys finished for me last year, since I retired last year. So now I'm just living off pension and then all my real estate and stuff. So I think it changed based on how you guys, on whether I look at the effective tax rate was where you finished it off for 2023. Mm-hmm. And I'm basing it off of that. But again, I don't know. Like, I guess it would know a lot better.
So when you're doing Roth conversions, it's not based on your effective though. It's based on your marginal, right? Yes. So like, for example, because let me show you how this works, right? So in this scenario right here, let's say I make $100,000. Okay, I'm just giving you an example. Can you guys see the Excel? Okay, so if I make $100,000, the first 23,000 of that is getting taxed at 12%, right? So I'm paying 2,300. I'm paying 2,320 on that first $23,000. On the next call it 71,000, I'm paying 12%. Right? 71,000 times 12%. So there I'm paying 8,500 on that. And then if I'm making 100K, that means on 5,700 I'm paying 22%. Right? So my total tax that I paid right here is 12,000. So my effective tax rate is 12%. Right? But if I do a Roth conversion, I'm already in the 22% tax bracket. So I'm going to pay 22% on the Roth conversion. So that's why when you do conversions, it's based on you want to look at your marginal tax bracket, which is just taking your income, putting it here, and then figuring out which bracket it in. So like, if you make 100K, marginal tax bracket wise, you're in the 22% bracket, but effective tax rate wise, you're only paying 12%. Does that make sense?
Oh, I thought it uses the effective. The way I get it, I know it's kind of a progressive tax system, right? And I thought it's based off your effective, because you're utilizing the average of those three, but you're actually using like your marginal, which is the highest basically. So it doesn't matter then.
Well, for income tax purposes, it is based on your effective tax rate, right? But for when you're doing like one time a year events like these, it's always based on your marginal. That's how we like, as finance people, that's how we rationalize these decisions. Is if you were to go and convert 100K over to Roth, you're paying 22% in taxes on that conversion.
Oh, I see. Got it.
But then play this out. So right now your effective tax bracket is 12%. If you convert that 100K, we're converting that at 22%, we said, right? So now your total income for the year is 200,000, and the total taxes that you paid were 34,000. So then your effective tax rate goes up to 17%. It's still not 22%, but it's 17% now.
I see.
Mm-hmm.
Okay. And I think the one last thing I heard you mention earlier, and I'm just trying to rationalize why that was the case, was where you said, don't tell them to take out the taxes. Do it at the end of the year when you kind of, I guess, consolidate everything at the back end of the year.
Yeah, because look, so if you're gonna convert 100K, they're gonna want to withhold the 22,000 to pay the 22% tax, right? That we just talked about. So then you're only going to have 78 that goes into the Roth if they withhold it. You don't want to do that. You want 100K going into the Roth, and then you want to pay if you have the means to, you want to pay the 22,000 with out of pocket cash or whenever you file your tax return.
Right. Got it. Okay.
And this is important for everybody to understand, like, the government puts limits on how much money you can put into a Roth account, right? There's the 7K Roth IRA limit. There's limits on converting. There's limits on this, limits on that. And that's because they understand how powerful like Roth is. Okay, so anytime we can like cheat the system or take advantage of that, get as much money in Roth as possible. Like we don't want to pay the $22,000 in taxes using the Roth money. We want to pay that with out of pocket dollars.